Dan, the market action as it was unfolding, it seemed like the general tone from Powell of some tolerance of higher inflation readings at the same time they're keeping their two potential cuts on paper was enough for a market that's kind of oversold and was down 1% yesterday, and we obviously still closed below yesterday's high.
You do the work all day long, and you talk about a lot of these indicators, the sentiment, and again, it was pretty oversold. And whether you're looking at it technically, whether you're thinking about it anecdotally, just talking to folks on the street, and, look at the degrossing that we've seen over the last few weeks, but also the pace in which the market sold off. It's really hard for us to put that in some context. We've all been doing this a long time. I think that's one of the reasons why, especially if you're like a retail investor, you didn't really have time to think about a whole heck of a lot the way in which we just went down 10% in a straight line. The good news is the S&P, the silver lining thing that I do, most of the time, is that the S&P is only down 3.5% of the year. You know what I mean? So maybe they took a lot of this euphoric sort of price action in some of the biggest names in the market that we've all been talking about this concentration for a long time. I think almost more importantly, it's the meme stocks like Palantir that went to 100 billion, then 200 billion, then 300 billion. Right. To see the back of some of those things broken makes me feel a little bit more optimistic that you might go back into the prior leadership if we do sort of get an all clear on some of the tariff stuff and some of the rate stuff.
Yeah, I mean, ex-Mag 7 market's up this year, and sometimes the Mag 7 acts as defense. We'll see if that can happen again. Mike, what's your take on how the bond market took it? Obviously, yields pretty much down in a pronounced way across the board.
Yeah, I mean, listen, I think the bond market's pretty much what you expected, right? You didn't have a huge change in the dots, obviously still pricing in 2 cuts, higher expected inflation. You expect a steeper yield curve, and that's pretty much what you had from the bond market. You had a steeper yield curve. I think that probably continues to steepen as well. When you look at, UMISH inflation expectations, you look at input prices, you look at the Fed's own forecast, and then you look at the lower growth, at 1.7% GDP, you'd expect a steeper yield curve. So I think, listen, the bond market seemed to take this in stride. I think we're going to be in a range-bound market for some time. I do think you could go higher on rates because if you do get a stronger equity market, if growth doesn't disappoint, you don't get down well below 2% on GDP, if earnings remain strong, then essentially the Fed is remaining easy. Liquidity is plentiful. Look what Bitcoin did today. And you could actually see higher yields in the back end. And so that's, I think that could be in the future over coming months.
I mean, Powell was pretty dismissive of the University of Michigan inflation expectations number. Now, when it's convenient on the way up, inflation, he was grabbing hold of it. But I do think in general, that's the big debate. And he sort of characterized it this way, too. When we've seen consumer confidence, CEO confidence, small business confidence plunge from high levels, and what does it mean? Does that actually get transmitted into real hard data? And I think that's the vigil right now that we're.
Yeah, and I mean, I think Chair Powell mentioned this during the press conference in the sense that oftentimes the soft data, the survey data, doesn't actually translate into the real economy. But remember, a lot of the data that we're seeing on the economic side is lag data. So we don't really know where things are going to go going forward. The best thing that we can model are profits, and profit growth still remains pretty healthy. And so, that's sort of my cue in terms of where the equity market's going to go from here and, really sort of where the opportunity set might be.
So, Karen, do we put the Fed in the column of things that have the markets back, or is it still just sort of completely, in the middle here?
I mean, I guess I think of it as having a put, but it's not an at-the-money put at all. It might be, several percent out of the money, so I don't take a lot of faith in that. But I have noticed, I mean, discretionary, which that consumer number was terrible, yet the stocks did seem to bottom right around that time.
Yeah. They were stretched, I'm sure. Guy, I'm usually a, Fed balance sheet doesn't really mean
No, thank you for mentioning that, because the runoff, this reduction in the runoff.
Yes.
Yeah. You're 100% right, going from 25 billion down to 5 starting in April. And I think that's what the market sort of took its cues from. In that initial run higher, people are saying, party on, we're going to go from QT to QE. I don't think it's that linear, in my opinion, but I think the market took a lot from that. I think it's one of the reasons that yields might have gone lower in a meaningful way. But with that said, you can also make an argument that that could potentially be sort of inflationary as well. So it works in the short term. It might sort of nip them in the bud in the longer term.